welcome back, everybody. So today we have a super special guest. His name is Victor Stefan. If you guys don't know Victor, he is actually the agent that I bought my latest duplex from. He has a huge deal list that he sends out to, I'm sure, a lot of people by now. I mean, I've been sending a lot of people to your deal list. But yeah, found a duplex through Victor. It actually, maybe we can talk about that because I don't think I've ever updated you on that. But it's doing a little bit better than I was expecting. Super thankful for that. And we're going to get into a lot of topics today. A lot of it is going to be, scaling an out-of-state real estate portfolio. I know a lot of my viewers are from the Bay Area. We're going to be talking about probably a lot of random stuff. Like you did mention that you own a wedding venue that's doing pretty well. And then I also want to talk about how you're finding deals, because for anybody who's in W-2 and wants to step away from W-2, I think the main limiting factor is deal flow. A lot of them are not finding enough deals to be able to replace the income that they have, especially in the Bay Area where you have a lot of income. So welcome, Victor. And maybe you can just do a quick introduction first.
Yeah. All right. Well, I appreciate you having me on. I think this will be fun. There's so many different channels that we can kind of go down and rabbit holes that we can dive into. But introduction wise, all of my clients, every single one of them, they're all investors. That's all that we do. If it's somebody who's buying a primary, we just cannot take the client. Our services and our systems are not set up to support it. But if it's a high W-2 person, usually on the coast, looking to buy in the Texas market, that's our client demographic. We're sourcing deals and we want to find high quality assets and high quality locations that cash flow positive. That's really like our entire MO. And then we end up getting into all sorts of like real estate backed businesses, and we can kind of go any direction that you'd like. But in essence, I think, high W-2 earners, people who are out there actually hustling, getting work done, and want to reposition capital into real estate. Those are the people I talk to and work with every single day.
Yeah, for sure. I have a lot of software engineering friends who are very, they put a lot of their money in stocks. It's a great way to diversify. A lot of them are looking to diversify, actually. And I actually pulled up your daily deals here, so I'll screen share just for a second, just to show our viewers what that actually looks like. But I signed up for your daily deals probably a couple years back. But I mean, Victor, maybe we could talk about this first, which is like your deal flow, right? Like it seems like you are scanning all the on-market properties. I don't know if you're doing off-market marketing as well. But actually, I was looking at this one recently, the clean 12plex. I was looking at this one I think.
What is it on Gilbert? Is that what it says there on the
Gilmer,
or the Gilmer one? The Gilmer one,
yeah. This one was pretty sweet. So cash flowing almost $3,000 a month. This is actually what I've been looking for recently. So yeah, I may have to look into that a little bit more. But this is the daily deal list. You put your name down, put your email, and he just sends you an email with I don't know, anywhere from 4 to maybe I feel like you have a lot these days. I think the last email had 8 or 9.
The last email had 15, but it was a little bit of an anomaly just because it was like a catch-all. But yeah, the daily deal list, that's something that I've been doing consistently 3 times a week since 2017. 3 times a week, it goes out like clockwork, and it includes all of our on and off market inventory. The deal sourcing, I know, is something that you kind of wanted to get into. But it's on-market deal flow, it's off-market deal flow. It's also pre-listing. It's also stuff that's already in contract that we know is going to come back to market. And I wish I had a really clean way for all of your listeners to go ahead and establish the same types of systems. But a lot of the off-market deal flow comes to me because other agents know that I work with a ton of investors and they need to move something. I'll have other people who are like, hey, I know that the buyer is going to go ahead and terminate this contract. I know you have a lot of people. We have to move it quickly. Can you push it out? Here's the price that they're going to accept. Right. So we have a lot of that inside track type of stuff that comes through. But also I'll get 10 people a day who call us through the website. And now that we've established a track record in this business, and people who will call us and say, hey, I'm looking to sell this type of property. I see that you work with a lot of investors. Can we get a deal done? And they'll tell me a couple of preliminary numbers on the phone. They'll say, yeah, it's pulling in $3,000 a month. I want $555,000 for it. And I'll say, sorry, we can't work with you. Right. And we'll go ahead and we'll refer that listing out to an on-market person. But if I get somebody who comes through and they say, hey, Vic, we've got this quadplex in San Antonio market. We need to get about $600,000 for it. It's fully occupied. It's pulling in about $1,400 to $1,500 per door. I say absolutely yes. We do a quick underwriting. And within about 12 hours, we're pushing them out to our deal list. So we're fast
Wow.
and we know it's going to work. We know it's going to work with like basically within about 30 seconds of talking to a seller, and we can go ahead and push it out. So a lot of our clients who've been watching that deal distribution, they'll see some real unicorn opportunities out there.
Yeah, for sure. I think it didn't show on the website, but because I didn't click download the report, but the report actually has a very detailed, it basically plugs in the numbers into like a rental calculator, and it shows you all the calculations like vacancies, maintenance. It throws in all the expenses that you would anticipate, and then gives you like a number at the bottom with the cash on cash right there. Boom. Nice and easy. You do a lot of the legwork for people like me, which is why I ended up buying a
Yeah.
So
Initial stuff gives you a framework to build off of, but every investor,
exactly.
like as you know, they're gonna have to plug in their own elements
For sure.
that are most pertinent to that specific investor. For example, like when an investor comes through the deal list, they might have a different down payment requirement. Maybe they're buying it as like an owner occupant style deal. Maybe it's a single family house. We underwrite everything assuming 25% down, but obviously you know that you can buy something with 0% down. You can put as much down as you'd like, but we do definitely give a framework on which to like start building, right?
Yeah, I like how in the email you also have a little blurb that kind of gives you like the inside scoop, like, oh, this seller is like, you know, he's ready to sell. He'll do a little bit of seller financing. He'll do like, you give the little inside scoop that like doesn't show up on the MLS. So that's really nice too. I like that.
Yeah, I appreciate that.
But yeah, that's the deal list, guys. I mean, I think I've been referring a lot of people to this deal list because I think it's amazing. And yeah, maybe somebody bought the property that I would have otherwise bought. So I don't know if I should be sharing this so freely,
maybe
but
you're
like
shooting
I have
yourself
been,
in the
'cause it's amazing.
foot.
Yeah, but it's amazing. I mean, I bought a property, so like I can share a little bit about the property that I bought from you. So the one that I bought from you, it wasn't from your list directly, but it was the same seller. She was selling one duplex, and then she had another duplex. The neighboring duplex, it wasn't on the market, but she was planning on selling it, and ended up buying it from her. It was right next to a big college, and then I ended up adding 4 bedrooms and 2 bathrooms to the duplex. So it went from a 3-2 on each side to a 5-3s, and then I rented by the room.
Yeah.
So we're renting like 10 rooms basically. So it's like almost like a small little multifamily at this point, but it's doing a little bit better than we expected. So these are the type of deals you can find on Victor's list, you know. It's
but
insane.
also like there's an element of an investor. There's certain investors who I know are going to be successful. There's other ones who won't. What makes for a successful real estate investor? Incredibly, and I hate that this word is like a common vernacular now, but high agency, like incredibly high agency people. And you're one of those people who like, you say, hey, okay, here's what the number, an average investor looks at it and says, all right, we're purchasing this asset for $700,000. It's leased out right now, and all of the market comps suggest that we can rent out each unit for $2,000 a month. Somebody looks at that and says, okay, I could do $4,000 in gross income on a $750,000 purchase. And it's like, nope, deal doesn't work, delete it. You are like, okay, major university presence, looks like there's a square footage, we can add the bedrooms, we can add the bathrooms, and you were able to go ahead and capitalize on an incredibly well-located asset. And then you had the enough agency to go ahead and actually execute on a model that a lot of people would be intimidated by, right? So it's not just about the deal, it's also about the type of investor who's purchasing.
Yeah, I mean, at the end of the day, it's a numbers game. But yeah, I wasn't sure if it was going to work out. I mean, 10 rooms is a lot of rooms. And we finished renovations like just 3 weeks before the school year started. And we needed to fill up in 3 weeks. And luckily we were able to. But from your daily, or I guess from your daily deals, I'm sure you get a lot of people reaching out to you like, hey, I want to buy this deal. I want to buy that deal. How many of these investors are like first time investors? And how many of them are like experienced?
Good question.
Investors?
I bet it's about 50-50. So like oftentimes what'll happen is we'll go ahead and push out content that's more geared toward a more seasoned investor base versus a more introductory style investor. But I bet the vast majority of the experienced investors who come through are because they've already closed deals with me, right? So it's probably 50. There's what the biggest difference between like the new investors that I work with and the more seasoned investors that I work with, and this is maybe counterintuitive, but the new investors that I work with, they're very, very numbers focused. They're very cash on cash return focused, very cap rate focused. They're trying to alleviate any kind of like like dissonance in their brain about like what the actual expenses are going to be. They don't like anything to chance, so they want to see all of the actual expenses, and they're hyper conservative in their underwriting. That means that in order to get properties that pencil on paper, they're kind of forced into these like lower income neighborhoods. They're forced into these assets that have maybe a lot of deferred maintenance. There's a reason why on paper it looks like the rent is so high relative to the purchase price.
Yeah.
Whereas a lot of my clients who come through and they're more seasoned, they've already been through, and this isn't to say like new investors, like everybody does that. Everybody buys that property that's an absolute dumpster fire because it looked good on paper. You almost have to do it. It's like a rite of passage.
Okay.
But
Yeah.
the seasoned guys who come through, the biggest ones who come through are like, okay, it's excellent location, excellent asset quality. Let's go ahead and pull the trigger on this one because I
Yeah.
know that relative to the purchase price, it's an incredible location and it'll still pay for itself. So let's go. That's a
Yeah.
big
Yeah. Yeah.
differentiator.
Yeah, no, that makes sense. I think as a beginner, a lot of people just don't know what their buy box is, and they don't know what type of buy box works, and so I guess the main thing, or if I had to ask you, I guess the first question I wanted to know is like, what should the buy box of a first time out of state investor be? Like, what do you think in today's market is the buy box that you would be going after if you were a first time investor? Let's say
Yeah.
let's talk about like my audience. Like I think I have a lot of software engineers, a lot of high earners who maybe
Yep.
have, young kids. What is a buy box that you would suggest
I
for
love the
them?
question, partly because I answer it almost every day. So the software engineer who comes through, who's got a young family, they're living in the Bay Area, they've got great W-2 income coming in, and they are incredibly risk averse, almost always. What you want to do is like start the portfolio on a really positive foot. So you're encouraged to continue to scale, continue to grow the portfolio year over year. What I don't want to see is you purchase an asset and say, call me in 6 months and say, hey, Vic, this thing was absolutely terrible. I had all these issues with vacancy and management issues and maintenance expenses. So there's 4 main risks when you start talking about buying a piece of real estate. And for that first time out of state, very technical type of a buyer, I want to solve for all 4 of those risks in order to move forward on a deal. The 4 main risks being asset quality, location quality, vacancy rates, and cash flow. So asset quality, typically that first-time buyer from out of state with a high W-2 income is going to want to buy something recently constructed in the last 1 to, say, 7 years. Right? They want to buy something recently constructed. They know that it's not going to have a lot of surprising maintenance expenses. Maintenance expenses, for example, like a nice built quadplex on pier and beam foundation, are going to be monthly. You're going to have constant things that come up. Even if it was a fresh renovation, you're going to have constant issues that come up with that asset. So buy something built in the last 1 to, say, 3, 4, 5 years on a slab foundation. Number 2 is location quality, right? Location quality is going to be directly correlated, and you can get into some trouble for saying this, but it's going to be directly correlated to your tenant quality. So locations that have low crime rates, that have highly rated schools, are incredibly important to make sure that you're aligned with a high quality tenant pool. High quality tenant pool means that you have less tenant issues and less management issues, less management headaches. You have less missed rent payments. You have less people who are just skipping out in the middle of the lease, and all of a sudden the manager goes through and says, hey, there's nobody here. And they left in the middle of the lease without telling anybody. And you also have this idea of more aggressive rates of appreciation in areas that are rated higher quality because they're more desirable. More people are trying to get in there, more dollars flowing in, fewer assets. It drives prices up. It's supply demand. Vacancy. Almost always that new buyer from out of state, one of the easiest ways to get a deal that really works for them is buying a product that is already tenant occupied. So you find a property, there's already a tenant in place. You know exactly what you have to use as your top line revenue number in order to calculate what your bottom number cash flow is going to be. So we want to find an asset, ideally, that's tenant occupied. And if it's not tenant occupied, we want to see that it's in a super high demand area. We're talking vacancy rates like you put the same product out on the market, it's going to fill in 3 days. We want to eliminate that fear of vacancy. And then that last one is going to be cash flow. And this doesn't mean that it has to be a cash flow number, 10% cash on cash return like a lot of new investors think they should be targeting. This is something where does the rent, the current rent ideally that's already in place, does it cover your principal, interest, taxes, insurance, management fee, a small vacancy buffer, a maintenance buffer, maybe a CapEx buffer? Do you get to 0 after accounting for all of those elements? And if the answer is yes to all 4 of those criteria, that's the deal to move forward on. So solve for asset quality, neighborhood quality, cash flow, and vacancy. That's where I would start as a new investor.
Yeah, I think so too. I mean, I think as a new investor, you don't really want to be buying these like huge fixers. Like you said, it could maybe take a little hit to your morale if you were expecting some numbers and then boom, like plumbing issue comes and just destroys your numbers.
No,
It might not be the best experience, but
yeah, it's not going to be maybe. It is 100% going to happen, right?
it happened to me. Yeah.
It's 100% going to happen.
Well, let's talk about that for a little bit. Like, because there were some aha gotchas that I didn't know about Texas when I bought there. Because the first property I bought in Texas was exactly what you just mentioned. It's like a new construction. You know, it rents for pretty high compared to what the purchase price is, and so I'm cash flowing maybe like $100-200, but it's brand new. I mean, I bought it like a year and a half ago. I haven't got a single phone call from that place. Like, it's brand new and nothing's breaking. So, whereas the duplex that I bought, a little bit more issues because it was built in the 70s. So. Yeah. I think one thing that I, didn't know about Texas is the foundation issues. So my property, when I bought it, I actually didn't do a foundation inspection because I didn't know that, I don't know, maybe you can explain it. I still don't know exactly. All I know is that over time, Texas soil is a little different than California soil where it's not as compact maybe. I don't know exactly. Maybe you can explain that or that maybe. And like any other aha gotchas that that is only specific to Texas where you operate.
Yeah. Every state has like their ism, right? Texas in particular, we have what's called highly volatile clay soil, right? So we have these highly volatile clay soils and they expand and they contract aggressively depending on the moisture content in the soil. There's certain sections of the state that have a rich amount of that in the soils. Really the only area that we work is in Austin, on the far west side of Austin, that doesn't have those soils. It's closer to bedrock, similar to California, similar to like the coastal states where you're built on top of bedrock without this thick, deep layer of soft, squishy soil that'll settle over time. So Texas, I'd say probably 99% of the time when we do an inspection on a property and we get that inspection report back, there's going to be between 2 and 3 inches of deflection across the span of that foundation. Even new construction homes are going to have an inch of deflection, like almost 100% of the time. So that's definitely something to consider. Another thing to consider is when you see a foundation issue in California, and you're like, oh my goodness, like this has some kind of foundation deficiency pop up. That's like a major structural issue. That's something that could cost $20, $30, $50, $100,000. In the Texas market, you see something that has the front right corner of the home is 2.5 inches lower than the front left corner of the home. Maybe that's a $3,000 fix. Right. So it's totally different in terms of scale. Obviously, there's issues where you could have a $20,000 or $30,000 foundation repair in Texas. But overwhelmingly, what you see is differential settling across the slab or differential settling in those piers. For example, pier sinks 6. Pier and beam foundations are very easy to work on, but because they're so easy to work on, they also they're so malleable, right? They're changing all the time. So that pier could sink 4 inches into the ground.
Yeah, well, I didn't even know what a pier was before I bought that property. I mean, you might be familiar, but for those unfamiliar, it's literally like, it's like a column. It might be different materials. It could be a metal, it's literally like a metal shaft that you stick deep into the ground, or it can be like a concrete, literally think of literally a pillar that you kind of just shove underneath the house so that it kind of just doesn't sink. And so I did get quoted for it. I think it was about $10,000. But when I was talking to my contractor, he's like, "Hey, honestly, it's not that bad. Like you could live without it." So we didn't do it. But
that's a big word from your contractor. Usually the contractor's like, you know what, this is gonna probably cost $40,000, but because you're my buddy, I can do it for 10.
You can put in any number of piers, right? Like like one guy quoted me like, you need 12 piers. The other guy's like, you need 36 piers. Yeah. So it's a little tough there, but
also let's talk about this for like 20 seconds. There's a huge difference incentive in terms like incentive structure between going through a foundation repair company in Texas as compared to going through a structural engineer. So what your clients and what your user base who's looking to buy in Texas is going to be looking at is like, hey, all right, there is a foundation issue at this property. Like, check, we know there's an issue. Is it something that's serious? Is it something that needs to be addressed? You could hire a foundation repair company, go out, there's an inch of deflection. They're going to quote you $7,500 to repair that foundation. You could hire, but they're not going to charge anything for the site visit. They're going to get on site. They're going to say, hey, yeah, look at these elevations. Here's what we suggest in terms of remedy. It needs to be corrected. Look, there's 2 inches of deflection on the span. Or you could go ahead and have a structural engineer go out. The structural engineer is going to charge you $500 for the site visit. But they're going to say, hey, this foundation is performing as intended. And they're going to give you a stamp of approval that says you're good to go. So one is a free service. They're going to give you a $7,500 quote. The other one is going to give you a stamp of approval, but they're going to charge you $500 for the site visit. So many times my clients will say, well, this guy's going to go out for free, but this guy's an engineer and this guy is just a foundation repair company with no real credentials. So keep that in mind as you start going through the Texas market.
Yeah. I guess with that, like, is there any other, like, I guess things that maybe an out-of-state investor they don't understand about Texas? It's a little different than
Texas
California,
is like a buyer beware state. So when you look at, you've probably seen this, when you look at a seller's disclosure notice in Texas, totally different than California. Like when you look at your seller's disclosure notice in Texas, everything is going to be marked as unknown or as basically NA, right? There's just going to be very, very little disclosures from the selling party. That puts all of the onus on the buyer to perform their due diligence, find out what they need to find out. And a lot of people who come into the market, they're not comfortable with that. Like I know a lot of your seller disclosures out in California, they could be pages and pages and pages long with every little nitpicky thing being detailed prior to that person even submitting the offer. That is 100% not the case in Texas. So you need a reputable inspector to get on site.
Yeah, and definitely do a foundation inspection.
Yeah,
Don't
do your
be like me.
foundation inspection, get your elevations done for sure.
Yeah. Okay. Well, I guess I thought the percentage was going to be higher. When you said 50-50, like new and like more seasoned investors, I thought it was going to be like 80 new, but it seems like you have a lot of like repeat investors, which is great.
A lot of repeat. Yeah.
Yeah. And I still look at your deal lists. I'm still looking. But yeah, I guess one question I had was, what was the most painful lesson that I don't know when you started investing, but what was the most painful lesson you learned the hard way when you first started investing?
Yeah.
And I don't think I've ever asked you about your investments. Do you have like your own portfolio on the side? Like how long have you been doing that for?
48 properties, 6 states. The most painful ones, nothing is really painful. It's more like you either like learn from the opportunity or you won the opportunity, right? So I think if I look back, it wasn't necessarily painful, but I learned a lot. There's lots of learning, not so much winning in this situation. When I first started buying, and this informed a lot of the thesis that I use now when I advise clients. When I first started buying, I was 100% like spreadsheet focused. I was looking at the cash on cash returns. I was like, okay, if I can reduce my total cash out of pocket and I can increase the income from the asset, my cash on cash return is 70%, right? Like the ridiculous numbers that we were doing. And I didn't know how directly correlated your cash on cash return and cap rates are with risk associated with the asset. The higher your cash on cash return, it is a direct corollary to the amount of risk that you're incurring with the asset. So in our case, right, when I was looking at like seller finance deals, putting 5% down on the $90,000 8-unit complex in like middle of nowhere, Pennsylvania, yes, on paper, the math was a 70% cash on cash return. So I thought I was the smartest person to ever live. Like, why isn't everybody doing this? But the reality is you can't account in your spreadsheet for every tenant issue that you're going to have, every vacancy that you're going to have, every major repair that you're going to have. And like, yeah, you're returning a 70% cash on cash return, but like even on paper, your net cash flow, because you're levered to the teeth, is like $1,000. And that is not enough to offset the cost of a major plumbing repair. And I did that. Unfortunately, I scaled very, very quickly when I first started buying property because I was taking all of my commissions. I was working in New York City at the time. I was taking every single commission and I was flipping it into these like super high leverage seller financed transactions. Like if I put 10% down on something, that was a lot. And that was like 10% down on like a $90,000 quadplex, you know, so I'm putting like sub 10% or sub $10,000 down on these things. And, I ended up building a very large portfolio over the course of like a year. And then a year is not enough time to really feel the pain of all these repairs. But then all of a sudden year 2 comes and like the newness and like the excitement of it fades. And every single month you're like fighting to collect the rents, but you keep having to hire contractors, you know?
Oh yeah.
So that was the hardest pill to swallow. It's just like a big piece of humble pie right in the beginning.
Yeah.
But then, you know, you quickly, you offload it, you kind of like clean up your act and you're like, okay, I want to look. Now you start to optimize for location and asset quality, and you get a little bit better, and you know you distill and synthesize your investment criteria from there.
Yeah, I mean, you have to price in the cost of your sanity too. You know what I mean? Like these properties, they have a lot more issues, and if it's bringing in an extra $500, like I'd rather just have the peace of mind at $500 a buck or $500 a month. Me, like I have a property in Sacramento that the numbers worked out okay, but you could have never guessed. But like a homeless person burned down half my building, and it cost me like what 7 months of it being vacant because nobody could live there for 7 months. Right. And it's not something that I put in my spreadsheet when I was writing it up or underwriting it. So,
and how would you know?
Exactly. You can't.
It's impossible to.
But it happens way more than you think. That's the thing. Like it happens way more than what people think.
Yeah.
Especially when you have 8 units, I mean, I'm just talking about one, right?
Yeah.
So, yeah, it's tough. You said you mentioned real quick that you used to work in New York. How long ago was that? And what did you do then?
Yeah, I was at Wells Fargo I was a headhunter. So I was working for a third-party firm, and we were headhunters for Wells Fargo. We were recruiting high net worth financial advisors. So people who were running, a book of business, a financial advisor at, say, Morgan Stanley doing a $100 million book of business. We were poaching them, for lack of a cleaner term.
Okay.
We were trying to get them to come over and bring their book of business or client base over to Wells Fargo.
Oh, I see. I didn't know that. Okay. So then I guess a lot of this podcast is me trying to like interview people because I'm kind of in a point where I want to transition to real estate full time. Like, give me a little insight about what that looked like in your life during that period. Like, how did you make that decision you were going to switch over, and how did you do that? And what was your like feeling at the time? Because right now I'm in that position and there's a lot of anxiety, I will say, whether or not I'm going to be able to replace my income from my software engineering job, which is classically known as like the golden handcuffs type of job. How do you make that decision, and how do you make that? Yeah, I guess how did you make that transition is the question.
So I'll jump like 3 steps forward in the story and say I was on the couch with my fiance at the time. We were going to get married. This was January, and we were going to get married in March of 2020, which you know what happened in March of 2020. And I said, "Oh yeah, I left my job." And she's like, what do you mean you quit? I was like, I stopped working there the first of the year. I told him a while ago I was going to stop on the first of the year. And she's like, we're going to get married. We have to like talk about these things. It's the first time I was like, oh man, I really do have to like kind of like loop you in on these things that are going through my brain. But a couple steps back, the plan for me right out of college was always to go ahead and get into real estate full time. I had a really good mentor. I was very, very fortunate. This guy, I went to a small school in upstate New York called Colgate University, and I loved it up there. I had a really terrific mentor, and he owned like everything. He owned like the laundromats downtown and a couple of the restaurants in town. He owned all the student housing, and I would manage some of his apartments for him over the summer when there was like people who were living on campus for the summer doing whatever, mostly athletes who were there training for the summer times. And I'd collect the rents and manage the leases and take the little phone calls that came in. And I was what, like 22 years old, 21, 22 years old. And it was awesome. And I'd meet up with him. I collected rents weekly because I didn't just collect everything on the first of the month. It was basically like whenever the people had cash. I had like probably 55 or 60 properties that I was just knocking on the doors and collecting cash and checks. And every single Friday we meet up at a restaurant. I'd have a stack of cash and checks like this thick, and I'd hand it over to him and we'd just talk about real estate. And he was like, Vic, if you want to get into the business, start off with like a base plus commission type of a setup, get into sales in some capacity. That base income will help you qualify for conventional or FHA financing, and the commissions will give you that lump sum of cash that you need for down payments. And that's exactly what I did. I started working on that headhunting job. They had a small base that helped me qualify for conventional financing, and every single placement that we had, I'd take that commission check, float into a piece of real estate. And I should have probably ran it by ran it by that guy, those deals when I first started buying, but I was like, I know so much. I'm so smart. I'm going to buy this sixplex in Scranton, Pennsylvania for $80,000.
Yeah.
So yeah, that
I
was
feel like
how it
every
started.
Bigger Pockets listener goes through that phase, like just buy the cheapest real estate you can find, because on
Yeah.
paper those things rent for like higher than the 1% rule, right?
Yeah.
Like 60,000, but it'll rent for like 1,000. Like the numbers look great.
Exactly. But like, wealth is built through appreciating assets, like real wealth. Like people who are actually generating wealth and from these things, they're buying assets that are like very high quality, like scarce assets. They're buying stuff in like very high demand locations, and those things don't sell for $100,000. There's all sorts of arbitrage opportunities out there, but like real wealth is generated from buying like premier real estate.
Yeah. I think there's always this question. It's like a never ending debate whether cash flow is better or appreciation is better. And I'm still arguing or like debating with this between my wife, because I'm much more like, hey, we should cash flow. But my wife is like, we should buy in the Bay Area, and nothing in the like you buy a home in the Bay Area, it's going to negatively cash flow $3,000 a month, but who knows, maybe it goes up by $500,000 in 3 years and it was all worth it, But we actually went with the Bay Area route when interest rates were low, 3%. And we could get it to a point where we're putting like maybe 20% down, and we'd be negative like maybe like $800, $1,000, but holding on to A-class property in the Bay Area, which has worked out.
Yeah.
We have 2 of them now, and they've appreciated quite a bit. But now we're at this phase where, and maybe I can get some of your advice here, because I am thinking about transitioning away from software. Sure. But if I transition away, like we have no income. And so phase 1 of our current strategy is to sell the Bay Area homes. And then we have one in Sacramento, and throw that all into some multifamily in the South. We're looking like Alabama, somewhere where you can get close to the 1% rule.
Get out into West Virginia. West Virginia is your best combination of rent to price ratios, super low insurance premiums, super low taxes. Insurance taxes don't go away even if you own it free and clear. So like the West Virginia market is if you're looking for like a fixed income, which is what you're describing, a fixed income kind of a play, we love the West Virginia market.
Okay. I might have to talk to you about that more, because I was looking at Alabama, Tennessee, Oklahoma, and Texas, but Oklahoma has a lot of natural disasters, more than I was expecting.
Insurance premiums are high. So like the insurance element in Oklahoma, low tax rates, which is great. Lot in Oklahoma, if you want to look into Oklahoma, lot in Oklahoma for like larger multifamily assets. Like you could buy a 20-plex in lot in Oklahoma for $1 million and do fine.
Yeah. I wasn't too sure about the insurance piece, because it seems like there's like a lot of tornadoes and earthquakes. I didn't really know they had that many natural disasters out there. But yeah, so that's currently the plan, is we want to shift a lot of our equity, which is sitting, I guess you could call it lazy equity, which is we're just praying that the appreciation goes up. But in the meantime, we're suffering because cash is rolling out of our wallets. Unless this thing appreciates, like that's the only way we win. But we wanted to make it more sure. And since I'm going to be leaving the job, my income is going to be dropping, it'd be good to replace that with some cash flow. So that's kind of like phase 1, is to get to like the 10,000 number, which is kind of where our expenses are. So that's like phase 1 of, I guess, financial stability, because we are planning on maybe having kids in the future and stuff like that. And then from there, once we're not bleeding money on a monthly basis, we're going to kind of really go all in on real estate and maybe syndicate. I think, we're not going to have any dispensable cash ourselves at that point, because we're going to deploy most of it into these deals. But we're hoping to use these deals as kind of like a track record, so that maybe we can do more deals. But I think that's why I wanted to have you on, is because I think the main bottleneck in this plan right now is the deal finding. So I know you do you said for your deals, you're doing a lot of the on-market analysis. Do you think that an investor can build like a solid portfolio just on market, or do they have to go off market? Because you always hear off market deals are the best, but is it possible?
There's different types of, I think, standards for deals, and also different expectations for growth in your portfolio. If the idea is that you want to go ahead and scale a portfolio like quickly, you want to do it in a year, and you want to have a super high cash flow style play, you're probably going to have to find like that unicorn style asset. And it might take, you'll find them on market. It might take 4, 5, 6. For example, we sent out a deal out in the clean market for $1.99 million, maybe 2 or 3 days ago, 09 Root Ave. And I hope somebody buys this thing, because it's currently pulling in $25,000 a month in gross income on a $2 million purchase in Texas, close to the second largest military base in the country. So you've got a ridiculous tenant pool. This thing is a 31 unit asset, and 30 of the 31 units are already occupied. So that's like the unicorn style deal that you should be targeting when looking at like a fixed income kind of a play. But I look at hundreds of properties every single day, and this is like the best one that I've seen in probably a year and a half or 2 years. So they do hit the public wires, but if you want to do it like quickly, you're going to have to open up every channel that you have. So you'd probably have to go into an off market strategy as well.
I see. And when you say go off market, like what do you think would be the best way to source these leads then? Because I got a lot of feedback that, a lot of the people that I know, they say like a majority of their deals from agents.
Mm-hmm.
If you're me and you're just starting out, do you think the best way is to go direct mail or just call a bunch of brokers like yourself who have these like pocket listings, who have all these connections? How would you go about finding deals in these type of like in any given market?
The answer is probably all of them. And I hate to give that answer because like realistically, when I've got people who come through and like, hey, you have any off market inventory? And like, I just get like a random phone call from that. And it's like, no, like, why would I give it to you, this random person, when I've got this huge well of repeat clients who I can absolutely bless their lives and they've already closed with me. I'm going to give it to them. There's not like you're not going to be a random person who does a random phone call to a random broker and get that unicorn listing. I think something that might be more beneficial and also cost effective is property management relationships. And there are property managers who you call, and this is part of my strategy. There are property managers who you reach out to and you say, hey, Joe, I'm really looking for this type of product. I know that you guys are managing 1,000 units. Are any of your owners looking to sell? And almost always the answer is yes. They're going to know the owners who are like, hey, this guy's getting a little tired of the game. This guy's actually looking to offload a decent percentage of his portfolio in the next 12 months. I could go ahead and like float an offer. So and that's something that I do every single week. I'm reaching out to probably about 15 different property managers, and we just reach out like, hey, what's coming up? Any kind of like chatter around who might be looking to offload. And 100% of the time, the answer is yes. Here's what we're looking at. And then you can make the decision from there if it fits.
That makes a lot more sense. Yeah. That actually, I didn't even really think about that. My plan was just to call a bunch of agents and I don't know, maybe just never really thought about it from the agent's perspective. Yeah. But that makes sense.
Yeah. The property management is going to have way more access to investors, and most investors, they're selling every 3 to 7 years, right? It's not like these people are really holding for decades.
Makes sense.
Even if they had gone in with that expectation. So the managers are a major key when it comes to sourcing off-market deal flow.
Cool. Awesome. Well, we're running a little bit over time now. So I think the last thing I wanted to talk to you about is kind of like this recent trend, which is like, and I got kind of caught up in this too, right before, just a couple of weeks ago, I was looking for a boring business to purchase.
Yeah.
But I think the overarching theme is that people, at least me, like I'm getting tired of the W-2 and I want to transition to something else, but trying to start your own business is very daunting. But I wanted to ask you about your wedding business.
Yeah.
Maybe you could because you just briefly mentioned it, like, what is that like? And how did you get into that space and like, why weddings?
Sure.
Why wedding venues?
So it's a business that's backed by real estate. So I know what I know, and I know real estate. The wedding venue business, we bought this property because it was a phenomenal property. We bought it at an auction. It failed to meet the reserve at the auction. Then I ended up reaching out directly to the owner, and we were able to get a deal done.
Well, when you say auction, I never quite understood. Like, where do you go for an auction?
This was a Sotheby's auction. So this was like this property was a little over. It was posted for about $2 million. It's like 180 acres. It's like about an hour and a half outside of New York City. So it's in the Northeast. Like this. It's got like 4 giant ponds on it, like beautiful woods and hay fields, and this old like 1800s farmhouse and big barns. gorgeous, gorgeous, gorgeous property that we had been looking at for a long time. But I was like, I'm not going to pay. I think the asking at that time was like 2.4 million. I was like, that's a little bit crazy. And then we were watching the Sotheby's auction. I was watching it online. I was registered. I was like a registered bidder for the property. I was looking at the property. Nobody was really bidding on it. It failed to meet the reserve. It came off of the auction block. I was like, oh my goodness. So I ended up reaching out directly to the seller, got a deal done. And this was like something that my wife and I had set up as like a 10-year type of a vision. Leave Texas during the summer because it gets to be 110 degrees here. Go up into the Northeast where I have a lot of family, spend the summers there, let our boys run around and play and jump in the water and get dirty and get lost out in the woods. This property like fit every single box that we wanted to check, but it came 10 years too early. So we're like, all right, if we buy this thing, how can we use the property to basically pay for itself? Look at what a lot of investors are looking at with their rental real estate. And we were starting to look at this thing. It's like, okay, like what can we do with it? Can we go ahead and can we sell inventory? Can we sell hay? Can we do like a firewood type of a business? Can we grow blueberries? All these ridiculous things. And we ended up being like, well, what about weddings? And we had a couple of relationships who are already in the wedding business. And the property is like an absolute like picturesque place. So we ended up partnering with a manager up there. She's like, hey, if you guys go ahead and build it, I'll manage it. So we had a great relationship for management. We pre-sold a lot of weddings, which put a ton of stress on my wife and I, because now we had, 50 weddings booked for, 2025, but we didn't have a venue yet. So we ended up that was a way for the property we had 3 main criteria. We wanted the property to stay expertly maintained, because when we bought it, the place was immaculate. We didn't want to be like the new owners from out of state and the place just goes into disarray. So we wanted to do an expert maintenance on the property. We wanted to make sure that the property paid for itself, and we wanted it to be a source of joy and not a source of stress for my family. Those were the 3 kind of criteria that we set in place before we ended up purchasing. And the venue more than pays for itself. It's highly profitable. It'll give me an exit from the agency side of the business. The source of joy, not a source of stress, hasn't exactly come to fruition yet. There's a lot of more so about like the construction and development side of it, but like actually like running these venues, we got like great reviews. I love reaching out to the couples afterward. Like it's so much fun. It's like
it must be really fulfilling. Yeah.
Different part of my brain that I get to like exercise, right? And like being able to share this huge and amazing property with like hundreds of people every single weekend is awesome.
Yeah.
So that was kind of how we got into like the business backed by real estate component.
Yeah. That's really cool. I did consider doing a wedding venue as well, especially when we were getting married, because we were looking around being like, holy crap, like these numbers are insane. They have to be insane. If they're doing these every single weekend, like they have to be making like crazy money. I think all my friends who are engaged looking at venues, they all come to the same, like, they all have this, like, they all think that they have this great idea. They're like, what if we started a wedding business? And like everybody who's already married is like, guys, like we already thought about that. Like every person, all my friends who go through that process and they see how much these venues make, they're like, we should start a wedding business. But I guess you're the only one who's done it. So that's awesome. But Noel, thank you so much for coming on, Victor. I really appreciate it. I mean, you're just, a well full of information, and it's a privilege for me to talk to you and kind of basically just berate you with questions here. So I really appreciate you coming on. And is there, I think I just wanted to leave the guests or the podcast listeners with your social media here. It's, I guess it's just your name, Victor Stefan, on YouTube, Instagram, and are you on TikTok a lot?
Yeah. Across all channels. You'll see us post very, very frequently. I try and get about 30 pieces of content posted out there every week. So you'll see the chatter.
Yeah, but I think your main kind of entry point is the daily deals link, which is victorstefan.com/daily deals. I'll put it in the description below. But yeah,
definitely.
Sounds like your kids are ready for you to come out and play with them now.
They're crazy, man. But they're a lot of fun. They're so much fun. They just like playing with Dada. And we go out and we ride the bikes and go fishing down the ponds and whatever. So it's fun.
Well, that's what it's all about.
Yeah, I appreciate you having me on. Give me a holler if y'all end up needing anything, and I can't wait. Hopefully we do this one again.
Sure. Cool. Thanks for coming on, Victor.
You got it.